Late 2025. Tariffs are rising, rhetoric is escalating, and money is moving in the opposite direction. $70 billion. Not promised, not discussed, committed. While Washington sharpens its trade weapons, that capital does not flinch. It does not wait. It does not negotiate for mercy. It leaves. This is the contradiction that matters. At the exact moment the United States escalates tariffs against its closest ally, foreign capital flows into that ally at a scale that should not exist under pressure. This is not market noise. This is not a coincidence. This is a verdict. Tariffs were supposed to force compliance. They were supposed to extract concessions. They were supposed to remind Canada who holds the leverage. Instead, they triggered something else entirely. Pressure, then rerouting, then loss. The tariffs arrive first. 25% on goods, 10% of energy, then more, louder, public, weaponized through humiliation and threat. The message is clear: obey or bleed. But capital does not respond to volume. Capital responds to risk. And risk, at this moment, is no longer located where the tariffs land. It is located where they originate. $70 billion flows into Canada, not as charity, not as sympathy, but as calculation. Infrastructure, energy, artificial intelligence, critical minerals, long horizon assets that do not chase headlines. They flee instability. This is the part that breaks the old model. Because tariffs assume dependence. They assume there is nowhere else to go. They assume size equals gravity. But gravity has changed. What follows is not retaliation. It is a replacement. Not anger, but architecture. Not protest, but planning. This is how power erodes now. Quietly, invisibly, one balance sheet at a time. So ask yourself the only question that matters. If tariffs are power, why did the money leave instead of comply? Do you believe coercion still works in a system that can simply route around you? The logic behind the tariffs was simple. Brutally simple. America is larger. America is richer. America is indispensable. From that assumption flows everything else. If Canada depends on access, then access can be weaponized. If markets need America, then pressure will force alignment. Tariffs become leverage. Noise becomes power. It is a zero-sum worldview. One side wins, the other folds. But that logic only works in a closed system. And the global economy is no longer closed. The miscalculation was not about trade balances or deficits. It was about substitutability. The belief that Canada had nowhere else to go. That capital had no alternative destination. That supply chain could not be rebuilt without Washington's approval. Size was mistaken for indispensability. That error matters. Because the moment an ally realizes it has options, coercion stops being strength and starts becoming instruction. Instruction on how to leave. Canada did not argue with the premise. I tested it. And quietly, methodically, it proved it wrong. Canada did not respond the way pressure expects. There were no counter-threats broadcast at rallies. No insult for insult exchanges. No escalation designed for cameras. No emotional release. That absence was not a weakness. It was discipline. While Washington spoke loudly, Ottawa went quiet. Not passive, precise. The first move was legal, not rhetorical. Investment protection frameworks, trade architecture, documents that never trend, rules that outlast administrations. The kind of groundwork capital requires before it moves in size. Then came sequencing. Not everything at once. No public ultimatums, just a steady expansion of options. Europe, Asia, the Gulf. Each conversation is isolated. Each deal was insulated. Each channel opened without announcing it as retaliation. This is what gray rock looks like at the state level. No emotional feedback, no visible resistance, just an opponent who stops reacting and starts re-engineering the environment. At the center of that effort was Mark Carney. Not a retail politician, a systems operator. A man trained to read risk the way surgeons read scans. While tariffs dominated headlines, Carney focused on timelines, contract duration, capital lock-in, regulatory predictability. Trump's strategy was performative, loud, immediate, designed to force a reaction. Carney's was temporal, quiet, designed to change the future. Nowhere was that difference clearer than in critical minerals. Most discussions stop at mining. Who has lithium? Who has cobalt? Who has rare earths in the ground? That conversation is comforting. It sounds like an abundance. It is also misleading. The choke point is not extraction. It is refining. The slow, capital-intensive, politically sensitive process that turns raw ore into usable input: batteries, semiconductors, defense systems, artificial intelligence infrastructure. None of it runs on rocks. It runs on processed material. And refining capacity is scarce. Canada understood this early, not as an environmental talking point, as leverage. With clean power, stable regulation, and proximity to allied markets, refining becomes something more than industry. It becomes permission. Permission to build, permission to scale, permission to operate without asking Beijing or Washington for access. That is why the money arrived where it did. Not into headlines, into processing, into long horizon facilities designed to run for decades. This was not a decoupling theater. It was capacity creation. Every tariff assumed dependence on American access. Every investment quietly reduced it. This is the asymmetry that broke the escalation model. Noise demand response. Architecture does not. By the time the pressure intensified, the groundwork was already poured. Capital was committed. Timelines were locked. The exit was no longer hypothetical. It was under construction. And once that happens, there is no dramatic turning point. No single announcement where the relationship ends. There is only silence. And then, suddenly, absence. Markets do not wait for elections. They do not wait for speeches. They move when risk changes shape. The first signals were quiet. Contracts delayed, options clauses exercised, short-term agreements are quietly shortened. Cross-border buyers began inserting language that assumed disruption was no longer temporary. This was not panic. It was an adjustment. Exporters felt it first. Canadian suppliers rerouted shipments. American buyers hesitated to commit. Prices began to drift, not because of scarcity, but because predictability had evaporated. When tariffs change by announcement, pricing models fail. When policy moves on impulse, hedging becomes guesswork. That uncertainty is expensive. Logistics firms noticed the shift before the public did. Freight volumes softened on some routes, surged on others. Warehouses filled in the wrong places. Inventory buffers grew. Capital sat idle, waiting for clarity that never arrived. This is how trade stress manifests before it becomes visible. Not in headlines, but in spreadsheets. Executives adjusted guidance, not dramatically, just enough to signal caution. Forecasts added footnotes. Earnings calls included phrases like temporary headwinds and policy-related uncertainty. The language was careful, the meaning was not. Investment committees began asking different questions. Not how big the market is, but how stable is the access. Not what the margins are today, but what happens if tariffs escalate again next quarter. Those questions spread, slowly, methodically, from boardrooms to balance sheets. And while voters debated intent, markets priced consequence. Cross-border deals stalled, not canceled, deferred, waiting for a signal that never came. The longer the pause, the more alternatives hardened into plans. The more temporary workarounds became permanent habits. This is the phase most people miss. The period where nothing dramatic appears to be happening. No factory closures yet, no mass layoffs, no political reckoning. Just a low-grade paralysis setting in as capital waits and labor absorbs the delay. It feels calm because it is quiet. But calm does not mean stability. It means pressure has not yet found release. Tariffs do not hurt all at once. They accumulate, they distort incentives. They teach companies to behave defensively, to build buffers instead of capacity, to delay instead of expand. By the time the cost becomes visible to voters, the decisions that caused it are already locked in. This is the danger of confusing silence for success. Because while the noise stayed in Washington, the damage began elsewhere. In planning cycles, in procurement meetings, in the slow recalibration of risk that turns once routine trade into a liability. The system was not breaking yet. It was stiffening. And systems that lose flexibility do not snap loudly. They fail slowly, then all at once. The costs do not announce themselves at the border. They surface inland, quietly, in places that do not trend. An agricultural exporter in Iowa loses a buyer, not because the product changed, but because the risk did. A Canadian distributor delays renewal. A logistics firm reroutes capacity. A contract expires and does not return. No press release explains it. No speech acknowledges it. The revenue simply disappears. Tariffs raise prices first, then they erode trust. Buyers hedge, sellers hesitate, margins compress. The math stops working. Manufacturers feel it next. Inputs cost more, delivery timelines stretch. Inventory planning becomes guesswork. Orders that once moved seamlessly across the border now require contingency planning. Every shipment carries an asterisk. The response is predictable. Hiring freezes, capital expenditures delayed, overtime cut. These are not dramatic decisions. They are defensive ones, made quietly, repeated often. The pain does not concentrate, it diffuses. Farmers absorb higher costs. Processors absorb volatility. Truckers run emptier routes. Small manufacturers lose the certainty that justified expansion in the first place. The damage spreads horizontally, thin enough to be ignored, wide enough to matter. This is the human layer of policy shock, not a collapse, a grind. And while individuals adjust downward, institutions move differently. Above the noise, the capital remains calm. Canadian pension funds do not panic. They do not lobby. They do not posture. They reposition. Trillions of dollars, managed for decades-long horizons, begin evaluating exposure through a new lens, not return alone, reliability. These funds are not emotional actors. They are fiduciaries, mandated to preserve stability. When volatility becomes policy, stability becomes scarce. So, the money moves. Not all at once, not publicly, incrementally. Allocations shift toward projects insulated from tariff shock, infrastructure with long-term contracts, energy systems with predictable regulation, supply chains designed to bypass uncertainty altogether. This is capital as a weapon, not wielded in anger, deployed with patience. Every dollar redirected is a silent vote. Against unpredictability, against coercion, against systems that can change overnight by announcement. And while that reallocation happens, the individuals below it carry the lag. They wait for relief that does not come, for negotiations that stall, for certainty that never returns. This is the asymmetry that defines modern economic conflict. Pain is immediate for workers, optional for capital. When policy introduces instability, people absorb it first. Money leaves last, but when it leaves, it does not come back easily. The Iowa lament is not a protest. It is not a televised outrage. It is a pattern of adjustment that never quite recovers. Lost buyers do not always return. Rerouted supply chains do not always snap back. And trust, once broken, does not respond to volume. By the time the consequences become politically visible, the capital has already moved on. And those left behind are told to wait. Infrastructure does not argue. It replaces. Once routes change, they do not ask permission to return. The first adjustments looked temporary. Backup corridors, alternative ports, contingency clauses written in pencil. But contingency has a way of becoming default when risk refuses to stabilize. Rail traffic began to rebalance. Not dramatically, strategically. Volumes that once assumed frictionless passage through the United States were reassigned, tested elsewhere. Then I committed. Ports followed. Contracts were rewritten with optionality baked in. Gateways diversified. Timelines lengthened to avoid exposure to sudden policy shock. Each change is small enough to be defensible. Together, decisive. This is the ghost train effect. You do not hear it arrive. You notice it only when the platform is empty. Long-term agreements are the tell. They are not signed lightly. They are forecasts disguised as paperwork. When companies lock in routes for 10, 15, 20 years, they are not betting on reconciliation. They are pricing in permanence. The logic is simple. Infrastructure is expensive. Rerouting costs money. If firms absorb that cost, it is because the alternative is worse. Unpredictability is worse. From an investor's perspective, size no longer compensates for volatility. A large market that can close itself by announcement is not an asset. It is a liability. Reliability becomes a scarce resource. That is the inversion most people miss. Power once meant gravity, the ability to pull everything toward you. Today, power means stability, the ability to hold systems together without constant intervention. When reliability collapses, systems do not resist. They route around it. This is why the changes do not reverse when rhetoric softens. Infrastructure does not listen to tone. It responds to incentives. Once capital builds elsewhere, sunk costs do the rest. Facilities operate, contracts mature, workforces specialize. Entire ecosystems form around the new path. The old route does not vanish. It simply stops growing. And in a global economy, stagnation is loss. This is the structural shift. Not dramatic, not symbolic. Irreversible because it is rational. The United States does not lose trade overnight. It loses default status. It becomes one option among many, sometimes chosen, often avoided, always assessed. That is the price of volatility. The ghost train keeps moving, whether anyone is watching or not. There is no mystery left in the sequence. Pressure was applied, quiet alternatives formed, capital rerouted, infrastructure locked in, human cost followed, and the system adjusted without asking for permission. This is how coercion backfires in a networked world. Tariffs were meant to discipline an ally. Instead, they taught that ally how to leave. Public threats were meant to project strength. Instead, they reclassified the source of those threats as unstable. And instability, once priced in, does not argue its way back to relevance. The lesson is not ideological. It is mechanical. When power is exercised through unpredictability, it does not concentrate. It fragments. Allies do not rebel. They diversify. Investors do not protest. They reprice. Supply chains do not wait for reconciliation. They build redundancy and move on. This is the structural shift that matters. The United States does not lose trade because others turn hostile. It loses primacy because others become optional. The center holds only as long as it is trusted to remain open tomorrow. When access can change by announcement, size stops compensating for risk. Canada's response was not defiance. It was an adaptation. No slogans, no counter-threats, just contracts, capacity, and time horizons that extend beyond election cycles. That is why it worked. The consequences will not arrive all at once. They will surface as smaller deals are missed, as fewer default routes, as negotiations that begin elsewhere and arrive late, if at all. The loss is cumulative, not theatrical. This is the danger of mistaking noise for leverage. The power that must be shouted is already eroding. The power that must threaten is already uncertain. And power that relies on coercion in a world with options is power teaching others how to bypass it. The warning is not moral. It is practical. Reliability is the currency of leadership now. Spend it recklessly, and the market finds substitutes. Quietly, permanently. Send this to someone who still believes allies don't have alternatives.